What's happening, everybody? Welcome to the December 29th, 2025 IndiView Weekly Market Update. My name is Jeremy Bryan, and this is powered by Indy Wealth. Today, we're going to get right into the hot button topics of a pretty slow week. So let's get right into it. Let's start here. Consumer sentiment data came out recently again, and consumers are really saying things are bad. So you've got the consumer confidence numbers and you've got the University of Michigan Consumer Sentiment Index, and both of them are really, really down in the doldrums. I've hit on this before, but that hasn't changed. And in fact, it's probably worsened since the last time I spoke about it, is that the US consumer, and you're starting to see this just in general conversation, is the job market slowdown, and the job market, especially among that, again, mid to lower tier, tends to be an area of some consternation, which again, from that is the sentiment side, is when people feel like they can't get another job, if they lose their current one, or if they just want something different. If they don't feel like they can get it, that's what usually hits sentiment pretty hard. And typically, historically, consumer spending has gone down as a result. We're not seeing that this time around. All the holiday data suggests that people are still spending money, that things are still kind of progressing. People are still they're saying things are bad, but they're still acting as if they're not as bad as they're saying. So there's that dichotomy right now. I really do think that if the job market continues to worsen, then we're going to start to see a curbing of real spending. I don't believe we can continue on this rubber band of stretching those in such different directions without it snapping on us. So we do have to be a little cognizant of that. But I want to say on the other side of that is when, usually at troughs of this sentiment, usually when people feel this bad, usually there's a pretty good reason for it. But usually the market has had maybe some difficult times during that period of time. There tends to be some correlation there. Currently not now, considering we're basically at all-time highs for a lot of asset classes. But usually these sort of troughs in sentiment tend to be favorable for markets more than unfavorable. So I wouldn't use this as a cautionary tale of this relay, consumer weakness, consumer sentiment weakness leading to stock market weakness. It's not perfectly correlated. And in fact, usually it's the inverse. But again, we're in a little bit of a different time right now because we're at such high levels of the stock market while the consumer is saying things are pretty bad. So it's interesting. It's something we'll continue to watch for. Turning to number two, home interest rates. Home mortgage rates are down this year. They're down about 1% from where they were at the beginning of the year to now. So they are down. But over the past few months, we've really kind of just stalled out from an interest rate perspective. This 6.5 to 6.30, somewhere around there for the 30-year mortgage, and 5.5 to 5.75, these kinds of things for the 15-year mortgage. We've been kind of in that territory for a little while here now. And what I've been saying all year, and I still believe this, is at these levels, this is not an activity inducer, right? It's just still not affordable enough. To be honest with you, it's not just a question of rates making things more affordable. It no question does. That's absolutely the case, is that if paying 7.5 versus paying 6.5, you're paying less. The problem is housing prices. Again, in some markets, we're starting to see this roll over a little bit. I would call them more flattish than really rolling over aggressively. But again, just looking at this raw data of income levels, housing prices and housing costs to income levels, we're still at extraordinarily high levels. So we're starting to see some activity from the builders who are making incentives. They're making smaller houses to concede that prices are aggressive. So let's make the square footage a little lower. And they're also providing incentives to get people in, whether that's lower rates, whether that's lower prices, whether that's discounts on other things. There are some incentives to push people to pulling the trigger on the housing market. I don't know. I think this is just going to take some time. I think the affordability has to come down in one way, shape, or form. Now, again, lower rates falling from 6.5 to 4.5, that would have a pretty dramatic effect. And there could be some affordability from there. But I don't believe that we can just continue to raise prices, and have the activity follow suit just because rates are getting somewhat cheaper. So there has to be a bow that breaks here. I still don't believe the housing market, and I'll do this more robustly in a week when I do my 2026 piece. But I still don't believe that there's a lot of activity in the housing market. I don't see it getting significantly better in the next year. Turning to number three, absent this morning, where we're having some difficulty in silver. But if you look at silver and gold, I mean, they are just skyrocketing this year. Year to date performance for silver is now up 145%, right around that 145% range on a year to date basis. Now, again, it's almost all year, 2025. Gold is up 65%, right around that area too. So those two together, just dramatically positive performance this year in a market where, again, I've said largely that 2025 has been the year of diversification. I'll talk about that more again next week. But the year of diversification includes these commodities, includes these precious metals that are really, really starting to skyrocket. If you had an allocation, even a small allocation to these, it's been a pretty big tailwind to your overall portfolio. And again, you incorporate that with some international stocks as opposed to just US stocks, and everything around US has worked very well as well. So again, the US market has had a good year. Don't get me wrong. This has been a very strong US market year. It's just the other things, which rarely, hasn't been the case for a while. The US market has really been the engine for everything else. It was a lot of everything else really, really working this year, that if you held those things, you had an even better year than if you held just US markets. Turning to the last one, number four, I think a lot of us are feeling this right now as we've had a pretty decent storm rally here, and now we're facing some cold here today. I don't think it's supposed to last too terribly long. I think we get a little rise up and then we go way into the toilet for a little while in the cold. But I think we're all experiencing a little bit of snowflakes, unless you're in the in the lower bowl, which you never get any of that stuff. But one of the things that I observed yesterday, so I woke up and it was snowing. And I really like big snowflakes. I think that those are so cool when you get the really big ones that are coming down and they're coming down, they're just kind of floating down. It's just the most picturesque component of snow that you can have. So it's inconvenient. You still got to shovel it. You still got to snow blow it. You still got to drive around in it. But in the mornings when you wake up and you see the big snowfall that's just going down gently, it does remind me that I think I would miss not having some of that in my life overall. Like, I don't think I can be a permanent resident of a place that's just 75 and sunny all day long. Don't get me wrong. Some of these times, again, talk to me probably towards the end of the week when we're sitting at -5. I may be changing a very different tune. But I do like seeing the snow every now and then and taking a walk in the snow and that kind of stuff. So it's fun, and especially in the mornings when you can just look at it and you don't have to experience and the downsides of it. I think those big snowflake falls are pretty fun. So that's all I have. Again, there's not a ton going on this week, but tune in next week where we'll have our next weekly market update, and we'll also have our 2026 outlook piece. So until then, thank you very much and take care.